Do we need recording if we are live on YouTube?
As
Okay.
such, not required.
But in any case,
ठीक
we'll
है,
do.
राखी नोकिया.
So, yes, YouTube is done.
Any message which we can send to the participants again at this moment?
I'll send a reminder. Meanwhile, we'll start because the
क्वेश्चन तो
time.
चैट बॉक्स में આવશે ને લાસ્ટ માં અરે ઓપન કરો ચેટ બોક્સ ક્વેશ્ચન લાસ્ટ માં
Yes, yes. Do that.
the introducer may can say because I have covered more or less all question type answer
Okay.
my presentation, so if anything is there chat box they can send and it will be replied.
We have a Q&A box also and chat box
So
also.
at the end of the session all the reply will be covered.
So you need
can
to
just
take
announce.
it after the end of both the sessions કે તમારું પતેના પછી તમારા Q&A લઈ લઈએ.
I am okay with both, or as maybe Raj suggest.
I think we'll do one by one. After Kaushik sir's session, we'll have a 5-minute Q&A. And if sir is kind
Yes.
enough to be there
Fine.
till the end, so
Fine.
end ma bhi agar koi aise
That's
to
fine. That's fine.
sure.
Yeah.
Yes.
Very good evening, sir.
Mohit is also here, sir.
Hello, Mohit.
Very good evening, sir.
Very good evening.
મોહિત ફોન તેડો કર નાખો ને.
Myself?
Yes,
Phone.
ફોન તેડો કર નાખો ને.
Okay. Let me adjust.
Okay, so I'll admit all the participants. I'll resume the recording, and then Khushbu, we can start. Yep, good to go.
Good evening, everyone. On behalf of the MCTC, I warmly welcome all of you today to insightful session on the evolving landscape of the Companies Act. The year 2026 is truly a phase of transition in regulatory frameworks. While we are witnessing a significant shift in the income tax law after decades, the Companies Act is also entering its next stage of evaluation after nearly 10 years. This makes it all the more important for professionals like us to stay updated, adaptable, and ahead of change. Today's session is thoughtfully curated to address two very relevant and practical developments: the Companies Compliance Facilitation Scheme 2026 and the Companies Amendment Bill 2026 draft. These topics will have a direct impact on compliance strategies, advisory roles, and professional responsibilities going forward. We are privileged to have with us esteemed speakers who bring deep expertise and practical insights to the table: CS Kaushik Zaveri and CS Raj Kapadia. We are also glad to have presence of a few senior officials from the Regional Directorate of the Ministry of Corporate Affairs, Mumbai region, amongst our participants today. We extend a warm welcome to them as well. Before we begin, let us take a moment to appreciate the efforts of Team MCTC, led by Advocate Reenav Khakkar, for organizing such a timely and valuable knowledge session, especially on the occasion of Ambedkar Jayanti. With that, we now move to the most important part of today's session. I would like to invite Reema to introduce our first speaker for the evening and set the stage for technical deliberations.
Thank you, Khushbu. A very welcome to our speaker, Mr. CS Kaushik Zaveri. Zaveri sir is a practicing company secretary as well as a law graduate from Government Law College. He is a partner in Kaushik Zaveri and Company, providing corporate law consultancy since 2.5 decades. He is specialized in handling adjudication proceeding matters before the Office of Registrar of Companies and Regional Director. He is also specialized in fast-track merger and amalgamation, due diligence, and secretarial audit. He has appeared in NCLT offices, company law board offices, also the offices of regional director and other MC offices. He is an active member of WIRC-ICSI in the Professional Development Committee and also an active member at Chamber of Tax Consultants. He is regularly contributing to a leading professional magazine under Company Law Corner at Bombay Chartered Accountants and the Malad Chamber of Tax Consultants. He has also provided publications and articles in Free Press Journal and Vyapar Business Paper on the CCFS 2026 scheme. We welcome you, sir. Before we move ahead, I would request CA Reenav Khakkar to make a small announcement about the membership part. Thank you.
Yes, thank you, Rima madam. As Rima madam mentioned that our MCTC life membership costs rupees 5,000 rupees 5,000 for life membership, as we said. And the benefits of life membership are that we try to arrange such timely sessions, and apart from that, our income tax webinar series is also currently going on, and probably the last session is scheduled on Friday. And going forward in the next couple of months, we also have such other GST series and another topics as well, which are relevant for tax professionals. So I would urge everyone to become life member of Malad Chamber of Tax Consultants. And also, I would take the opportunity to present a digital memento to our first speaker for today. And I would request sir to kindly accept this. We'll be sharing the physical memento by courier to your office as well. But before that, I'd like to request you to please accept this as a token of gratitude from Malad Chamber of Tax Consultants for you to sparing your time on this holiday evening and sharing your knowledge amongst us.
Thank you very much, President, for this gesture. Thank you.
Yes, sir. So I think we can, yes, sir. The mic is all yours. The floor is all yours. Eagerly waiting to hear from you, sir.
Thank you, Rima Shah, for kind introduction. Good evening, one and all. Happy Ambedkar Jayanti. At the outset, I must compliment President Rinav Thakkar and office bearers and organizing team for arranging very timely this scheme, which is yet to start. And it's a evening. Tomorrow the scheme is going to start. So perhaps it is an appropriate time to organize and make awareness among the stakeholder. So I must appreciate and compliment entire team of MMCT, Malad Chamber of Tax Consultant. My presentation structure will be analyzing the circular, discussing important aspect of circular, distinction between the two scheme, earlier scheme and this scheme, current scheme, what is the difference? And thereafter, I have tried to compile important and sensitive points in a way that it clarifies the doubt of stakeholder, professionals, and businessmen, whoever are attending or would be watching currently or later on. So this would be the way of my presentation. Let us briefly understand the current scheme along with the previous scheme. The previous scheme was known as CFSS 2020, which was just before COVID time, Companies Fresh Start Scheme 2020. And current scheme is known as CCFS, Company Compliance Facilitation Scheme. Primary goal of the previous scheme was it is a one-time fresh start for defaulting companies and opportunity to resolve the issues, while the current scheme starting tomorrow, it's a felicitation with focus on active company, dormant status, and last stage striking of the case. So this is the opportunity for the current scheme. The most important part is about additional fee. There was a complete waiver in the case of 2020 scheme, 100% waiver. And in the forthcoming scheme, only 10% of the additional fee is payable along with the normal fee. The other important difference is earlier scheme covered all kind of form, while this scheme has select forms which will be discussed at a later stage. There was an immunity form covered under the previous scheme CFSS 2020, which is along with all document, one covering form that is called immunity form, claim form, and the current scheme has no such form. Another important aspect difference between the two is STK applications striking off. There was a normal fee applicable in the previous scheme, while here there is a 75% concession and only 25% is fees payable. And last but not least, MSC, dormant status, again normal fee in the previous scheme, but this scheme only 50% of the payable fees is required to pay. And this is the overall difference. We'll see now the prima facie, the important aspect of this circular. This circular was dated 24th February 2026, number 1, 2026, which was primarily for the purpose of all companies towards filing annual return and financial statements under Section 403 of Companies Act. However, as everybody knows, all the professionals are aware that 1st July 18, there was an additional fees were introduced, and that fees was ₹100 per day, applicable in case of delay filing and in case of annual return and financial statement without any upper limit. Then there was a lot of initiative by Ministry Corporate Affairs toward ease of doing business, liberalizing the compliances. And in view of that, the active companies has crossed the 20 lakh mark, and the rate of growth of the companies in the country corresponding to the increase in formalization of the economy, which consists of new age entrepreneurs. What is new age entrepreneur? It is a startup, it is MSMEs, OPCs, small companies and producer companies. Consequently, ministry got many representatives like chambers and association, Institute of Chartered Accountant, Institute of Company Secretaries, about condoning this additional fee, relaxing the penalties. Hence, ministry thought it fit to give one-time opportunity to allow company to file their document related to annual return and financial statement. And hence this scheme called Companies Compliance Facilitation Scheme 2026 CCFS has been introduced, making effective from tomorrow. Para 4 of the circular says that under this scheme, companies, inactive company and active company have the option to get their pending annual filing completed by paying just 10% of the total additional fee. If it is a 1 lakh, then only pay 10% of 1 lakh. Get their companies declared dormant in case company has no activity or not able to continue actively for whatever reason, then there is an opportunity to turn this active company into dormant status under Section 455 of Companies Act by just filing one form during the year, that is called MSC 1. Or ultimately, there is another option to strike off the company if there is no option, no opportunity, no scope to continue even as a dormant company, then it is striking off option is available in by way of filing e-form STK2 during this currency of the scheme by just paying 25% of the total or normal course of fees payable. So if normal fee is fixed at 10,000, so under this scheme, someone can apply to strike off by paying only 2,500. 75% is concession under this scheme. So this is a overall concession discount given in this scheme for 3 type of companies, 3 type of situation. Now let us understand the tenure. Total tenure is 3 months starting from tomorrow, 15th April to 15th July is the last day. Then circular provides for definition and relevant e-form. Again, relevant e-form is covered under later stage, but to briefly say, it is covered old Companies Act forms also and new Companies Act form also. Old Companies Act practitioner may recall Form 20B, Form 21A, 23AC, ACA for financials, 23AC, XBRL, Form 66 was compliance certificate by practicing CS, and 23B by auditor. So these were the old form is covered under this scheme, and new forms currently prevailing only to the extent of annual filing, AOC4 and MGT7 and related type of company like NBFC, CFS, XBRL, etc. So these are the only limited form under this scheme, unlike the previous scheme as we discussed. Then define rule and scheme. The other part of the circular describe applicability of the scheme. Now the scheme is applicable to all such company except the category 3, category 4 categories given. First is company against which action of final notice for striking of the name under section 248 of the Act and previous section 560 of the Act, old Act, has already been initiated by registrar. Now, just 1 month before the process is completed, then you can't avail this scheme because it is already striking of action is already been taken, initiated by ROC. Another type is company which have filed application, company on its own. First, previous case was by registrar, by authority, but second case is company on its own file application for striking of their name from the record of registrar. Third is companies which have filed for obtaining dormant status, section 455 of the Act before inception of this scheme. So dormant status is neither active nor striking off, it is dormant so that minimum compliance is applicable. Fourth is companies which have been dissolved by virtue of amalgamation process. So naturally the entity existence is lost. It is no more in existence. So it will not be considered. And E means vanishing company. This is a very important type. Vanishing company, as we know, which companies are disappeared, not available on registered office, director are not traceable, accounts and records are not filed, and only violations under this scheme. So vanishing companies naturally will not be considered for this scheme. Next part of the circular provides for manner of payment of the normal fee and additional fee. So as we discussed, normal fee is as per the rules applicable, and additional fee is just 10% of the, depending on the late outstanding period of the fees. So 90% here is exempted and 10% is payable. Every company which files an application for obtaining status of dormant company under section 455, they have to file only one form, MSC1, and they are supposed to pay only 50% of the fees payable, depending on size of the company, small company, non-small company, depending on capital. So if it is, say, 10,000, so 50% is payable, 50% is concession, only that much is payable. So that is depend on size and nature. And strike off, as we discussed, only 25% of the regular normal fee, which is fixed, 10,000 fixed amount. So payable is 25. So this is a mode under the circular. The other part, immunity of the pursuant to filing and other thing will be covered later on in the detailed manner in the slide by my senior colleague Shivam. So this was the important part of circular. Having discussed distinction between the two scheme and circular, now let us go into important intricacy of the issues, intricacies of various part of the circular under the scheme. So as we know, what is the objective of the CCFS 2026? This scheme is aims to provide one-time opportunity to defaulting company to file pending statutory document with the Register of Companies It aims to improve compliance level, ensuring corporate registry reflecting accurate information and allow inactive or defunct entities to opt for dormancy or closure at reduced cost. Now, which authority has introduced this scheme? This is Ministry Corporate Affairs. We have a same ministry for Ministry Corporate Affairs and Ministry Finance. The same madam is the minister under the Corporate Affairs also, Nirmala Sitharaman madam. Next question is, what does the scheme come into effect? As we discussed, it is for 3-month tenure up to 15 July, starting from tomorrow. Now, who is the eligible to avail the scheme? Here, the scheme is applicable to active companies, those who have not defaulted, those that have defaulted in filing their annual return and financial statement is eligible. And secondly, inactive defunct company looking to either complete pending filing or transition to dormant status or struck off the status. Let us understand now which company this scheme is not eligible. This is a very common question when we address to the professional. So there is a clarification. Generally, the following companies are excluded. Companies where the registrar has already initiated the final notice for striking of the name under section 248, companies that have already filed an application. This is all briefed in my earlier slides. So these are various companies which are not eligible. Now one can ask for what forms can be filed under the scheme. The relevant forms are also discussed between old act and new act, especially those forms which are Ind AS, NBFC, XBRL, and most important, foreign company 3 and foreign company 4 are here covered. FC 1 and 2 are not covered, but 3 and 4 are covered, which is basically relevant to accounts and annual return. Next is another question which normally asked by professional is whether current forms DPT 3 MSME or CHG 1 and CHG 4 PS 6 are covered. The reply is no. Under this scheme, it is clearly excluded. The benefit of the scheme, as we discussed, is only 10% and 50% and 25% concession is being discussed, and immunity is from certain penalties and prosecution related to delayed filing will be discussed shortly. Now, what is the mode of calculating the fees for pending annual filing? Normal fees always depend on the period of late filing, how many years it is pending, and as per prescribed under rules, it is to be calculated. However, additional fees is payable to the extent of only 10%. So, for example, filing fee is ordinarily 600 and the normal additional fee due to delay is 10,000. Then the payable amount would be normal 600. Additional 10% of 10,000 is 1,000 and total payable will be 1,600. Thus, instead of paying 10,600, the company pays only 1,600 under the scheme. Fantastic concession, one must avail this scheme. So let us understand the example with the various situations. Though it is briefly covered, dormancy, only one-time form MSC 1 with 50% fees. So if it is 2,000, then 1,000 payable, striking is 25%. Instead of 10,000, it is 2,500. If STK2 is already filed under the scheme, must annual filing be completed. Once, if you file e-form STK2 for striking off during the scheme, one has to pay only 25% of the fee. However, it must be up to date with the filing until it ceases operation or applies for strike off. So this is a period until it ceases operation and applies for a strike-off is important thing. What if earlier previous year financially unaudited and UDIN is not generated by auditor? This is important aspect for auditors. It has to be as per the ICAI guideline. UDIN must be generated as per ICAI norms. The auditor can generate UDIN on the current date and sign the financial statement accordingly. This is a UDIN question is very common while addressing to the professionals. Hence, it is covered. Does the scheme cover non-conduct of AGM for previous year? Again, this is a very common question raised by the professionals. As we know and as we have discussed during the circular, this scheme is only relating to the filing of late forms, outstanding forms, and hence it is covered only filing related matters, and AGM is not covered under the scheme. Hence, non-compliance related AGM must be complied with. Does filing under this scheme grant immunity from penalties? So the reply is yes. Under section 92 and 137 and additive 1 and FEPC 3 will be covered little later, but the answer for this question is yes. Again, all in immunity related question will be covered later on. Yes. Can additional penalty imposed earlier be refunded? Another common question by professionals. The answer is no. The scheme clarifies that where an adjudication order imposing penalty has already been passed, the liability of the companies and their officials shall not undergo any change. Does the scheme regularize all post non-compliance? Answer should be never. The scheme regularizes only filing related defaults. It does not condone fraudulent activities, substantive violation of laws, and non-compliance unrelated to document filing. Another common question is raised by professional and very relevant question is, I'll just keep on hold this question and reply. Does the scheme apply to director as well? See, director being officer in default along with the filing. So answer will be yes. The immunity from penalty and change in liability for default may extend to officer in default also. Coming to this question, does the scheme, what happens if an adjudication order or penalty has already been issued? Obviously, the scheme does not change the liability to pay penalty if here the period is very important to understand. The 30 days notice period for adjudication has already been expired. Now the scheme is starting from 15th April and someone has received 1 month before this notice. If it is more than 30 days, then it is expired, not applicable, no exemption, no benefit of this scheme. And an adjudication order imposing penalty has already been passed. So naturally, it has been decided. So this will not be, scheme will not be applicable. What happens if a company fails to avail the scheme? 100, very common question again. The important thing, as you know, tenure is getting over on 15th July 2026, and the Registrar of Companies across country shall take necessary action under the Act because opportunity is given to stakeholders, professionals, businessmen, entrepreneurs to avail this scheme. And to make this awareness, this program, study circle, knowledge centers are being organized for the awareness. So it is an opportunity to avail the scheme rather than to skip or miss the opportunity. So ROC definitely may take required action for those defaulter who may not or who have lost opportunity of availing the scheme. So one should conduct the review, professional, businessman, entrepreneur, attending this kind of seminar, webinar, lectures, meeting, articles. They should conduct review. They should approach relevant professionals, identify the pending filing, calculate the potential saving, decide the status, whether to file with a late filing, whether to have a dormancy, or whether to go for striking off within 3 months, that is till 15 July 2026. This was one more attempt and to have awareness among all kind of reader, businessmen, entrepreneurs, to make sure that initiative taken by ministry gets success, of attempt made by chambers like MCTC and others for awareness to the stakeholder, it gets success, and this scheme meet its objective. Thank you very much. This was my presentation on circular distinction and question answers. Participant may raise the query if any. Before that, I would like few aspects to cover by my assistant, my senior associate, Mr. Shivam, Company Secretary Shivam Asti. Over to Shivam.
Good evening, one and all. Myself, CS Shivam Asati. Thanks for this opportunity to present my presentation. As all basic criteria already covered by the sir, I will touch upon on the details relating to the scheme which are having legal impacts and opportunity that are having to the director as well as company, because non-filing of annual returns and annual filing lead to a disqualification of director as well as the immunity part which is provided under the scheme is relevant for the annual filing, which provide additional penalties. That is, even we have delay filing, there will be additional fees as well as penalty. So in this scheme, it is covered. So I already cover in the earlier slide details, basic detail about this scheme. Background of the scheme is also covered. The timeline start from tomorrow and expired at within 3 months timeline. Key benefit. So under this scheme, key benefits are provided through option 1, that is active company can do the needful annual filing and get their status and up-to-date filing as on date by filing these pending e-forms like MGD7, AOC4 and other related to the annual filing. Further, the benefit has already extended to only pay 10% of fees, additional fee. Further, old Company Act form also covered. Second option is provided for dormancy status. We will cover here what dormancy means and what is the provision under the Company Act for application of dormancy. So dormancy company are those company which are inactive and do not have any significant accounting transaction during the years and are considered inactive, but they are in future proposed to have any business. For time being, they can opt to have a dormancy status to take the benefit that lesser compliance will be triggered relating to the filings and other. So inactive company means those companies which do not have any significant accounting transaction in last 2 years. So significant accounting transaction are also defined under the Act. Here is the definition. Excluding these 4, all are the significant accounting transactions, like payment of regular taxes, any statutory payment to registrar is a non-significant accounting transactions, like payment of any maintenance of office and regular routine admin transactions and expense are not considered as significant. Those companies who want to be active, however, in future they have any opportunity to do their business within the same company, can opt for dormancy under the scheme with lesser fee. So compliance, we can see what are the compliance are applicable on the dormant companies. So dormant company compliance covered under section 455. While company want to opt for dormancy, have to file form MSC1, and annually once we have opted for dormancy status, annually the payment is there for maintaining the status of dormancy. So applicable fee you can see here by this table is depend on the nominal authorized capital of the company. Whatever the capital, out of that 50% fee is payable in this current scheme. Further, regarding compliance, even though you have opted for dormancy, you have to get your accounts audited, because only one form is to file, that is a combination of MGT7 and AOC4. In this regard, we can say MSC3 is a combination of annual return MGT7, where the detail of directors and board meeting held during the year to be mentioned, along with auditor statement to be attached in that form after closing of every financial year within 30 days. Further, this is the filing fee. So basically the idea behind that, even we have opted for dormancy, there need to be some cost and some compliance, not extend to what active company are doing the compliance. There are lesser compliance and lesser cost imposed on those company which are in under dormant status. Third option under the scheme is for striking off with lesser fee. Generally, ROC fees is for all companies is 10,000. However, in this scheme, only by paying 2,500, you can opt for striking off. So, however, before opting, there is a basic criteria prescribed under Section 248 of the Company Act. Basically, the eligibility, which company can strike off. So, first is either ROC will strike off by acting as a regulator, by suo motu if it's found that the company is not doing the regular filing, or if company is not doing any business, voluntary can make application under form STK2 after condition that all its liability are waive off, like the auditor have to give certificate of nil asset and liability. Further, here is the second point. The company is not carrying any business and operation for preceding 2 financial year. So immediate 2 financial year are considered if company do not have any operation and business. Operation and business here means the company do not have any revenue from operation. If company have any FDs and generating interest on it, it will be considered as other income. So main business operation, if revenue is 0 in last 2 years, the company is eligible if do not have any asset and any liability as on date, and even though they have not done the filing till the date business operation are seized. The proviso provide that the company have to do needful filing, as if any active company had not done previous 2-year filing. Suppose in financial year 23-24 and 24-25, last 2 years they have do not done the needful filing, and in future they do not want to continue the company in a active mode and no option to have any business and any operations. Those company can opt this scheme for striking off by using this provision that till the date the company has ceased business, that till date they have to be needful filing. After cessation of business, there is no need to file Form AOC4 and MGT7 for respective company. If the second proviso provide that if the ROC take a suo motu action, so here is the catch. If you voluntarily go and inform the ROC that from last 2 years we are not doing any businesses, we do not have any operation, we have nil asset and liability, so kindly strike off our company name as we have filed STK2. In that case, you do not need to have needful filing of previous 2 years in which no operations, no business operation or revenue is 0. However, if ROC issue notice under this provision, then ROC will ask you to do all needful filing. Means even though there is no business operation, you have to do the filings for striking of your name. So basically the catch is that due to this scheme, we can voluntarily opted for those company who do not want to carry business and above condition are satisfied, then such company shall opt for the striking of under this scheme without filing previous year AOC4 if there are no revenue and operation as already informed. Further, we have covered what scheme, which type of companies I have covered and which type of companies are excluded. So basically immunity and legal impact of this annual filing default. Section 92 provide for annual return MGT7 and section 137 is regarding AOC for financial statement filing. If company do not do the needful annual filing, so there will be a imposition of penalty, which is above the additional fee. So in further side, we will understand what are the penalties are imposed by the adjudication. What is adjudication? Under new Act, Company Act, the adjudication is introduced. However, in landmark amendment in 2019 and 2020 in the Companies Act Amendment Bill, the various section where the fine is provided, it is reclassified and substituted with the penalty. So wherever the in provision there are penalty means there will be in-house adjudication. So what is the adjudication? In general language, we know the adjudication. It is similar like that. The in-house mechanism provided and regulator is the ROC. Will in-house will adjudicate the matter, whatever the non-compliance and non-filing we have done. He will directly impose penalty on that instead of fine. Earlier there was fine. If any non-filing is done, then company have to go for compounding and good the compound done. So here is the basic difference between fine and penalty. So there are still various provisions under the Company Act which are covered by fine, where the compounding shall be done, or under new amendment, after amendment, there are certain section where only penalty is prescribed. So here are the few sections like section 99, where still there is a provision for fine, that is non-compliance due of holding AGM. If company do not hold AGM on time, then company have to go for compounding. While if company have default in filing MGT7 and AOC4, they now have to pay penalty under adjudication proceeding. So under this scheme, these two section provision for prescribing penalty are providing immunity under the scheme. So what is adjudication? As defined under section 454 of the Companies Act. Here the jurisdiction is given to Registrar of Companies for all over the India to impose penalty on the companies for non-filing or whatever the non-compliance with the provision of the Companies Act. As already informed, this is in-house adjudication mechanism provided for reducing the burden of NCLT and special code. For ease of doing that, regulator will do the needful in-house. For this also, the MC has set up new department called as Central Scrutiny Center, which was effectively come from in year 2021. The role of this department is to scrutinize the form which are filed under STP mode. So here we have to understand MGT7 and AOC4 are on the STP mode form. Once you file, they are automatically approved. At filing stage, there is no scrutiny done by the regulator. However, this authority is now set up to do the needful scrutiny on sample basis of those forms which are already approved. So now it is a highly chances that various company will receive so-called notice on basis of form they have filed under the current MCA V3 portal, as this will be directly scrutinized by the new department set up by the ministry. So ultimately goal is that whatever the defect and error are identified by this department will be transferred to the concerned register of company where the company is registered. After taking into that consideration, ROC will issue show cause notice and do the needful adjudication process initiated at their level. So as we discussed, difference between fine and penalty. Fine are basically where the offense are committed. So you can see various section as earlier stated, where fine and imprisonment are provided. There can be a compounding where default are considered. It is you have to pay penalty. This is the basic difference between both. Wherever the penalty is provided under the section, the adjudication proceeding will be initiated against the company and officer in default. These are some case laws or adjudication order recently issued by different ROC on non-filing or delay filing of AOC4 and MGT7. You can see what are the fines they have imposed considering that delays. Like you can see there are 900 days delay in filing. There is 962 days. Accordingly, they have imposed 100 rupees per day penalty. These are the penalty, not additional fee. Someone will get confused with additional fee and penalty. The additional fee is the processing fee. You can say you are doing needful filing at delay. So you have to pay processing fee of 100 rupees per day. However, penalty is the default you have committed for which you have to pay penalty per day. So another consequence with non-filing or delay filing in annual filing of company like MGT7 and AOC4 will trigger disqualification regarding to directors. It will directly impact the director dean. You have also need to understand that if company are not doing their filing for continuous 3 financial year, then director on the board of those company will disqualify from that company as well as on other company where they are acting as a board of director due to non-filing of any one of the company. So non-filing of annual returns directly impacting individual directors. So here is the section 164 which provide that if company do not do the needful filing for consecutive 3 financial year or nor apply for dormant status, as we have already covered what are dormant status, then therefore all director on the board will be disqualified for those company which have not done the needful filing. Understand? So basically under new system under MCA V3, the dean status you may see are approved still till date. However, many company have not done the needful filing till date. There are many companies have not done filing for 5 years, 6 years. However, their director dean status will be, you can see on status of MCA portal will be active, because in 2020 and 21, the various ROC have issued a list of disqualification of directors, in which they have listed down the directors in a company which have not done the needful filing. So this scheme provide opportunity because almost 6 years are lapsed. Now MCA have built a system in V3 portal that once if any of the company is not doing the needful filing for consecutive 3 years, the dean of that director will automatically disqualify. At current stage, there are many companies which have not done the filing for consecutive 3 years. However, they practically and legally are director are disqualified. However, their dean is approved. That's why this impact is not appearing at current stage. However, in upcoming days after this scheme, if opportunity is not grabbed by the directors and company, their dean will become disapproved or disqualification will be triggered directly through a system. So the basic criteria for directors to avail this scheme and do the needful filing, so disqualification will not trigger if under this scheme they have do the needful filing. As already discussed, penalty provide for section 92 and 137. In short, minimum penalty is prescribed fixed 10,000 and plus 100 rupees per day, which is maximum 2 lakhs for the company. And similar officer in default, MD director, 100 rupees per day, which is maximum to 50,000 individually. So we can understand this penalty and additional fee and normal fee complex situation with a simple example. Suppose any company which have not done an annual return filing and financial statement for 500 days. Suppose 2 years filing is not done. So under this scheme, normal fee is payable as per authorized capital of the company, while additional fee, as there is two form, MGT 7 and AOC 4. So 500 days into 100 rupees per day, it comes around 1 lakh rupees. Under this scheme, you have to pay only 10,000. So the gross saving for additional fee will be 90,000. Now come to next regarding adjudication penalty. In normal situation, if company even though do the needful filing, they have to pay additional fee plus penalty. So penalty as already discussed, 10,000 is fixed plus 100 rupees per day, which is come for company around 1 lakh 20 lakh, 1 lakh 20,000. And suppose any company have only 2 directors, in that case 50,000 on each director, it's come 1 lakh for 2 directors. So under this scheme, this penalty is waived off. That is the main crux. Additional fee provided 10% only and immunity from penalty. This is the main saving will be covered under this scheme, which is limited for this 2 section and other annual filing form related sections. So overall, you can say you have to just pay additional fee and do the needful filing. Your gross saving will be around 3,10,000 because the penalty will be also not imposed on the companies and director which have done the needful filing under the scheme. So condition for the penalty waiver is that any adjudication notice is not issued and you have done the needful filing. It is a normal course. No company have received any so-cause notice and under this scheme they have do the needful filing. However, if company had received any so-cause notice between this time period of 3 months or before this and within 30 days of receiving that so-cause notice from ROC, if company do the needful filing, they can avail the penalty waiver under the scheme. Similarly, cases where the immunity is not available is that if already any order passed by the adjudication officer or 30 days time limit is crossed from date of issue of notice. Similarly, for ADT1, FC3, these are all related to the forms of annual filing. ADT1, as you very familiar, that regarding appointment of auditor. Under this scheme, whatever the additional fee are coming shall be payable only 10% and no adjudication procession will be initiated if needful filing done under the scheme. If after closure of scheme is done, there will be a penalty provision under section 172, which is required. So the best opportunity is here for all directors and company to do needful. Otherwise, ROC will take a legal and strict action, as we have already seen what are the penalties under section 92 and 137 prescribed. This conclusion that company shall become either compliant company or if do not want to do business or can opt for dormancy status. Otherwise, the company do not want to continue business can opt for striking off. Thank you. Anyone questions?
It seems there are any questions.
I can see the questions on chat box. Is scheme available for LLPs? No, the scheme is only for companies.
Old balance sheet can be signed now, but AGM non-compliance has to be dealt with separately. This is a scheme only for filing. So AGM on compounding has to be taken care by way of non-compliance under compounding. Any other question?
Sir, I have a question. if the regular compliance has been done till 2024, but ADT1 has not been filed. So can that be filed under this scheme?
Yes, under the scheme, IDT1 is eligible. All the three annual filing, AOC4, MGT7, NDT1, FC3 and 4, these much forms are covered under the scheme. So IDT1 is one of the annual filing, it is covered,
And what about ADT3?
not
That is
covered.
for
It is
resignation.
clearly
Not
not
covered.
covered.
Okay. Okay. So ADT1 is covered in the scheme.
Absolutely, it is mentioned in the scheme.
Okay. Okay. Perfect.
Okay, anything, any more questions?
There is one more question saying UDIN in current date will do. So I guess as you mentioned, the AGM consequences would be there for that.
Correct.
Of AGM.
So ICAI guideline must be followed with Institute of Chartered Accountant, and AGM non-compliance has to be taken care separately.
So thank you, sir, along with CS Shivam for an insightful session and for explaining the scheme and the underlying circular in such a detailed and structured manner. The practical insights and clarity on the compliance aspects have certainly helped all of us better understand its applicability and implications. I would now like to invite CA Mohit Cholera to kindly deliver the vote of thanks for this session.
Yes. Good evening, everyone. Am I audible?
Yes.
Yes. So on behalf of MCTC, myself, CM Mohit Chudera, we extend our heartfelt thanks to Kaushik sir and Shivam Bhai for accepting our invitation today and guiding us about the company's facilitation scheme 2026. For our participants, I would like to tell that sir has been always kind to MCTC and he has been also contributing to our monthly bulletin since 1.5 years. And from that, we are coming to know the penalties and the repercussions of non-compliances in the MCA as well. Although we try to put that things in the CS box, but still we are made aware by him through his monthly bulletin. So as chartered accountants, it is extremely important for us to stay aware about that such compliances and practices. Even if we do not directly practice in this area, this knowledge empowers us to guide our clients better and make them aware of the benefits available under such schemes. So a special thanks to Kaushik sir for simplifying this puzzle of the scheme effectively, and especially in guiding us on the clarity on inclusions and the exclusions of the schemes, benefits, guidance, and also the cost benefit analysis of applying in this scheme. Also, lastly, I would like to thank Shivam Bhai for touching the legal aspects, the penalties, immunities, and elaborating the discussion started by Kaushik sir. So thank you once again. Thank you so much, sir.
Thank you.
And our next speaker is also on the call now. So
Thank
over to you, Kushbu.
Sir, before we start the next session, if there is one more question, if
Yes.
Shivamji or Kaushik sir can
So,
answer.
there is a
Sir,
question.
you
by
are
CA
not eligible
Rupal.
for asking.
No, there's a question by CA Rupal that company is dormant for many years. Regular compliances are done till 24-25 financial year.
Yeah.
Can it apply for strike off in this scheme? SKT form is not
Yes,
filed to
yes,
strike off.
Condition of that. Yes.
If the conditions are satisfied, it is eligible for striking off. Eligible.
First have to active that company.
Make the company active and then go for striking off.
So I guess it answers the
Eligible.
query. So now, as we move into the second session of today's program, let us shift our focus from compliance facilitation to the broader legislative direction of corporate regulation. The company's Amendment Bill 2026 draft assumes significant importance as it reflects the government's intent to further regionalize, decriminalize, and modernize the Companies Act in line with evolving business practices and ease of doing business initiatives. For professionals, this is not just about understanding proposed changes, but also anticipating the practical implications on structuring, compliance frameworks, and advisory strategies. Early awareness of these amendments enables us to guide our clients proactively and align with the regulative direction well in advance. With this context, we now move to our next session. I would like to invite CA Reema Shah to kindly introduce our speaker for this topic and take the session forward.
Thank you, Kushbu. It's my pleasure to introduce our speaker, CS Raj Kapadia. He is a fellow company secretary and a law graduate. He is the founder of RK Kapadia and Associates, providing full range services to the global clients in setting up businesses in India, including compliances and IPR aspects, sorry. He is registered as a trademark professional under the Trademark Rules 2017. He has completed the Young Entrepreneurs Program and the Mergers and Amalgamation and Restructuring Program from IIM Ahmedabad. He has completed postgraduate diploma in digital business jointly from Columbia University and MIT Sloan. He has been co-opted as a member of the Professional Development Committee of the WIRC of ICSI. He has been elected as a vice chairman of the Commercial and Allied Laws Committees of the Chamber of Tax Consultants and is also an active member of the Research and Publication Committee of the Chamber of Tax Consultants. He has addressed professional bodies including ICAI, the Chamber of Tax Consultants, ICSI, IIT Indore, and he has also contributed articles for professional bodies including CCGRT of ICSI and Chamber of Tax Consultants. Welcome, sir. I would request Advocate Rino Khakkar, our president, to please present a digital memento to the speaker.
Thank you, Rima madam. Once again, privileged to present this digital memento to Rajbhai. Thank you, Rajbhai, for once again accepting our invite this year to enlighten our members on the new proposed amendment bill. I'm sure there are a lot of takeaways after hearing to you. So looking forward to your session, sir.
Thank you very much, President Sir Rinav Khakkar, for inviting me and giving the opportunity to address the session. And thank you very much, Rima ma'am, for the introduction and Khushbu ma'am for introducing the session. I'll just share my screen. Is it visible?
Not yet.
Not yet.
Yes.
Visible.
Okay, it is there. Yeah, okay. Yeah, thank you. Good evening to all the attendees. And after the first session,
Yeah.
we will
Yeah.
now. Yes, sir. Yeah, so after the first session, we will now move ahead with the overall governance aspects and ease of doing business aspects which the NCA is proposing to introduce by way of the corporate amendment bill. This is at a bill stage. It is before the Joint Parliamentary Committee, the JPC, and it is also open for consultations. So as of now, without getting too much into a discussion, this session is purely intended to give a outcome. First session was on the compliance facilitation scheme, which was covered by Kaushik ji and CS Shivam. And now we will be starting with the corporate amendment bill with the amendments which are proposed. The amendments are proposed on these many aspects, which is the ease of doing business. Certain aspects are proposed, ease of compliance. We will see that the base for small companies is also enhanced to a great extent, thereby covering more and more companies under the base of small companies. There is operational efficiency. There are some aspects on that. There are new concepts, the forward-looking concepts, which are also introduced in the proposals. There are certain regulatory strengthening aspects with the NFRA being introduced. And also there are certain clarification, which is the drafting aspects, which have been also fixed. So we will begin with so as it is a corporate amendment bill, it also includes certain aspects of the LLP, the Limited Liability Partnership Act, as well as the Companies Act. If we will see the LLP Act, it was originally introduced in 2008 and certain amendments were then introduced in 2020, 2021. So the provisions of 2008 are still applicable. The amendments in 2020-21 were largely pertaining to certain provisions of the Companies Act, which were made applicable to the limited liability partnerships, which included the disqualification of directors, the investigation of books, and the beneficial ownership provisions, which were made applicable to LLPs. So now these amendments which are proposed now pertain to recognizing IFSC LLPs as an entity. These are already there under the IFSCA regulations, but now under the Limited Liability Partnership Act as well, these have been officially recognized. Now these are proposed to be rather officially recognized by means of these amendments. IFSC is basically the financial, this offshore financial territory which is located onshore. It has a distinct jurisdiction. It has a single unified regulator, which is the IFSC authority. It it streamlines approvals, various approvals which are required under various laws. The activities that IFSC can carry out is offshore like the activities broadly include offshore banking, capital markets, international stock exchanges, trading in global currencies, asset management, which is the AIFs, global leasing, offshore insurance, fintech, to name a few. And even for us as professionals, there are certain ancillary activities which are provided, which can be carried out, which include the ancillary activities including foreign currency accounting, international tax, transfer pricing, valuation, and also as company secretaries, the ancillary activities which can be provided include entities, incorporation in the IFSC, dual regulator. So the compliance and governance under the dual regulator. So the registrar of companies on the one side and the IFSCA on the other side, and also governance to global boards. So these are some of the activities, and with this we will move with the presentation. So I have tried to cover as much as possible the proposed amendment. I hope it is visible. This is visible, sir. So I am getting some issues with this, probably the net connection, which is a bit unstable. So I'll probably try to like stop my video so that the presentation is not impacted. In between, I'll also start the video. So as we discussed, that the IFSC as a concept is officially recognized now in these amendments. The definition of IFSC, IFSCA, specified IFSC LLP have been inserted. It is linked with the IFSCA Act of 2019. So next we had have a subscriber declaration. There is a prescribed format now that whichever the designated partner or the applicant which will be processing with which will be applying for the incorporation has to now specifically declaration has to be submitted in the prescribed format. And even as professionals, we will now have there is an amendment that wherever the professional is specifically engaged, only in that cases the certification is required. Otherwise, there is no. It is now proposed that the blanket approval or blanket certification by professionals would not be required unless they are specifically engaged. This same amendment is proposed in LLP as well as for incorporation of companies as well. So that is in a way the responsibility shifts from professional to subscriber now, and where professionals are specifically engaged, of course the certification is required. The IFSC LLP objects has to be aligned with the IFSC requirements. The registered office existing is that it can be anywhere in India, and it is then proposed as per, of course, IFSC regulation as well, that it should be located in the IFSC. There is only one IFSC currently in India, which is the GIFT city. So as per this, as on the date, once these amendments are made effective, the IFSC LLP, the name also it is provided that the suffix for the name will be XYZ, whatever name is this, XYZ IFSC LLP. So that IFSC LLP has to also have a registered office mandatorily in the IFSC. filing the changes. So there are certain relaxations which are proposed for filing of changes which are there for SEBI or IFSCA regulated LLPs. Even for annual reporting, only the prescribed class of LLPs will have to make the annual reporting. So that also is all proposed. Once it is made effective, we will have further clarity on this. It will lead to operational ease. Contribution, the laws were in of 2008. The all the details in this are all INR based, but for IFSC entity it is in permitted foreign exchanges. So that also amendment is proposed, that contribution can now be in permitted foreign currency. Existing LLPs also, there will be a specified time which would be given for conversion of existing contribution also into permitted foreign currency, and future contributions also in permitted foreign currency. Valuation, it was not prescribed as per the existing. There was no such specific provision for valuation, but now Section 247 of Companies Act is proposed to be made effective to LLPs as well. So wherever valuation aspect for LLPs would be there, it would have to be carried out by registered valuers. Books of accounts, again in line with the practice which is there, it would be so existing it is in INR only, but proposed it will have to be now in permitted foreign currency as well. It would be in alignment with the IFSC regulations. Conversion is allowed. So there was existing, there is only firm and company which can be converted into LLP, but now it is proposed that a trust also, a specified trust can also be converted now into a LLP. So this paves way for AIF structure. AIF trust which are existing in trust structures can now be converted into LLPs. There is a legal continuity which was partial, and now it is full continuity provisions which are proposed. Filing of currency. So again, for filing purposes, existing it is only in INR, but it is proposed to allow foreign currency for IFSC LLP as well. Appeals also, the existing provisions for appeal and adjudication were fairly limited this in the LLP Act, but now there is a appeal provision as well, which is proposed to be introduced, the appeal to central government officer as well as the application based adjudication proceedings, which we have seen in the first session as well. There is this adjudication base for penalties which are prescribed, that is also proposed to be introduced. So it is adjudication based. We are now slowly moving towards the adjudication based model, wherein most of the fines and imprisonments as well are now getting converted to fixed penalties which are liable for adjudication. Moving on now, these were some for LLPs which are likely to have a major impact and also provide for IFSC LLPs. Now going towards the proposed amendments to Companies Act, which are mainly for ease of doing business, as we covered in the at the start itself. For ease of doing business, they provide for governance, they provide for decriminalization. So first is the foundation, as we discussed, smaller company. So small company, the original thresholds were 4 crores and 40 crores. They were twin threshold, 4 crores of paid up capital, turnover up to 40 crores. Both have to be certified for the company to be known as a small company. It was enhanced somewhere in November, December of last year, December of 2025. It was enhanced to capital up to 10 crore and turnover up to 100 crore, which has recently been enhanced, and now it is further proposed to be enhanced to a twin criteria of capital up to 20 crore and turnover up to 200 crore. So as we can see, turnover up to 200 crore, capital up to 20 crore, like it would cover a wide range of entities. Large base of companies can now be covered and known as a small company, and this leads to a major compliance relaxation. If we go by the provisions which are existing as on the date. Then small companies have a separate abridged format of board report with limited disclosures. Small companies also have a annual return NGT 7A again with limited disclosures. Small companies are not required to prepare cash flow statement in the financial statements. They are also, as per the law, it is the small companies and OPCs only need to have 2 board meetings in a year. So all these relaxations will now be made, are now proposed to be made available for a larger base of companies, with the criteria being enhanced largely. Registered valuer, the definition has been added for the purpose of clarity. Financial year, again very important. As per existing, only the companies which are associate, subsidiary or holding companies of the other company, only these companies can make application for having financial year in line with the other company. But now it is proposed that all companies can make such application to have some other financial year instead of 31st March. So this is also one, in a way, ease of compliance or ease of doing business which is proposed. Again, in line with what was present for LLPs, we have for companies as well. There is a declaration by applicant at the time of incorporation, which is now required mandatorily as per the format, and also professional certification. So wherever professional is engaged, the professional has to certify. Otherwise, the certification is not applicable now as per this bill. Also, the bill gives for ease of communication as well, wherein it now provides for a email and the communication to shareholders, to various stakeholders also to be made via email and soft copy instead of mandatorily sending physical notices. This is especially in case of general meeting and notices. Email is sufficient unless any shareholder specifically requests for a physical copy. In that case, by applicable costs, the company can send physical copies, but otherwise email this communication would be good enough, and that would be by default applicable. There any changes, this it is a push towards a fully corporate interface. Any changes in the communication details, email, etc., has to be intimated to the company. Electronic service, as we just discussed, it is a mandatory electronic service for the prescribed class of companies. Member can retain the option to have physical, and like it is a recognition of a paperless governance, and there is also a fine-based punishment which was there earlier, and now it is proposed to have a fixed penalty of 2 lakhs. Next, we will move towards the capital and share, like share capital and related aspects. So first is the private placement, which has been broadened. Were included in the section, and in the heading itself, the word share has been replaced with securities. So now other also instruments are now would form part of the act itself. It is aligned with the SCRA, the Security Contract Regulation, and the related regulations as well. So even in section 42 and 4210, the 42 section, it also includes such other scheme linked to the value of share capital. So it provides for now this employee share based payments, instruments like RSUs and stock appreciation rights, and all these instruments also are now recognized in the Companies Act. And also the penalty, instead of a discretionary may extend to, it is now equivalent to that penalty has been now made effective, is proposed rather to be made effective. There is a new section which is proposed to be introduced for recognizing the IFSC companies in maintaining the share capital in foreign currency. So for a IFSC company, again, it is just to align with what is already in practice. It is just to align with the regulations. A company set up and incorporated in IFSC shall issue and maintain share capital in permitted foreign currency. So that is their existing. Also, IFSC companies, if any, may convert into permitted foreign currency, and existing IFSC company cannot issue share capital after commencement unless it first converts existing capital into permitted foreign currency. So once this is made effective, the existing share in a IFSC company has to be converted into permitted foreign currency, and then only any further share capital transactions can be carried out. So that is giving a operating model. Next is further issue, which is 62 section and section 68, which relates to buyback of shares. So in section 62, again, as we discussed in 42 as well, here such other schemes linked to the value. So here also the compensation schemes, the modern compensation schemes are recognized, which include RSUs, stock appreciation right, SAR, and such other schemes are also included now officially. Buyback is extended to schemes linked to the value of share capital, which exit mechanism now cover compensation instruments too. And also there are also same treatment for value linked schemes. So basically such employee related schemes are now recognized. Again, moving further ahead with buyback. So very important, and currently the aggregate of 25% of paid up capital is allowed for buyback, but now for prescribed classes, buyback may be up to such other percentage which may be prescribed. So the NCA has the power to prescribe such type of such percentage which can be bought back. And very important, frequency. So currently we can have only one buyback in a period of 12 months, but now it is proposed that prescribed classes may make up to 2 buybacks in a year, provided second one is at least 6 months after the closure of first buyback in that year. So this is an important for amendment. The declaration of solvency is now replaced by affidavit, which has to be done. So basically, it is towards ease of doing business and this flexibility as well. And there is also there was earlier a fine-based punishment, but now it is proposed as a penalty, which is 25 lakh for listed companies and 2 lakh for other than listed companies, and also officers for officers 5 lakhs up to 5 lakh for listed companies and 2 lakh for other companies. So this is again an instance where fines are proposed to be converted to penalties and going more towards decriminalizing. Delayed filing window for charges. So next we deal with charges. Existing, it was 60 days. This prescribed class of company or classes of companies, 60 days to be read as 120 days. So instead of additional filing window of 60 days, now 120 days is proposed to be introduced. So this is again relaxation in a way. Meeting and again, very critical and important change which is there, again towards ease of compliance and ease of doing business. We had, so till now we had till now we had a situation when where due to COVID restrictions, every year or every such period, the MCA used to have circulars which were providing for for general meetings to be held via audiovisual means. But there was no such provision in the act. We were only going by the circulars which were issued from time to time. But now the act itself is now proposed to be amended by way of this bill, wherein AGMs are now to be allowed in hybrid mode. So this proposal permits the AGMs to be held by physical means, wholly through video conferencing or other audiovisual means, or partly hybrid. So this is again a welcome change, that hybrid mode of annual general meetings is now proposed to be allowed. Again, if the number of members, as per section 100, if they request for a physical meeting, then physical AGM is required. Otherwise, the hybrid AGM is proposed to be allowed, and but with a condition that once in every 3 years, the physical AGM will be held. It is also a welcome change in a way for the companies. And similar also there are relaxations for extraordinary general meetings as well. It can either be by virtual means or hybrid means as per prescribed. Provided if members request, then physical EGM would be required. And also the notice period for EGM is proposed to be reduced to only 7 days notice now. For extraordinary general meetings, a 7-day notice would be sufficient. Next, for AGM default, again penalty also, instead of all sections referring to 96 to 98, now it only refers to 96, which is the scope is also narrowed, and it's a bit of re-languaging. And penalty is also proposed to be rationalized, which is 1 lakh of penalty plus continuing default 5,000 per day, capped at rupees 2 lakh for the company and 50,000 for the officer in default. IEPF framework. So important change in IEPF is that the transferred shares, not just the shares, but also unpaid or unclaimed dividend is also now to be transferred to IEPF wherever applicable. So earlier only shares were there, but now wherever shares have been transferred to IEPF, now the unpaid or unclaimed dividend also is to be now transferred. There is also the fund references. There is a word authority, which is like a drafting these changes which are proposed. But this is very critical, that now dividend also is now proposed to be transferred to IEPF. Next, about the books of accounts, NFRA also, and those aspects. There is a like existing again a case where fine is now proposed to be a penalty. So penalty of like 5 lakh for listed companies and 50,000 for any other company. So that is for books of accounts. This provision for books of account. There is also this differentiated this penalties as well. And for this section 131, which deals with revision of the books of accounts, if any revision, so 3 preceding financial year become 3 immediately preceding financial year. So that aspect is giving more clarity to the aspect. So that is just a drafting change which is proposed. Next is NFRA. There are multiple amendments also proposed for NFRA as well. So now it becomes a full regulator with these amendments. The personality is strengthened. The NFRA is constituted as a body corporate with perpetual succession and power to hold property, contract, due and be sued. There are new sections also to propose to be added, which would be the operational aspects. It provides for general superintendents to the chairperson, and all those aspects are added. The advisory, warning, additional training. The misconduct also expressly includes section 22 of the CA Act, meaning and contravention of the Act rules within the NFRA's ambit. So NFRA becomes has a real now value, and it is proposed. It is highly detailed amendments are proposed to be included in section 132A, B. These so mandatory intimation to ICAI for any such statements, false statement, omission, material facts. They may issue directions as well. So all these are compliance facing provision which are there in the left, and towards the right they are institution facing provisions which are the authorized for levy of fees, 132E, which bars the civil court jurisdiction. So all these aspects are proposed. Going forward, the board there are certain changes proposed in board report. So earlier we only had to reply, the board has to reply to only the qualifications, adverse remarks which are there in the board report. So board's response is only required for those. But now any such observation, qualification, reservations or adverse remarks, so any such thing, so any audit red flags, now board has to mandatorily respond. And also there is a proposal that where audit committee composition and reasons where board did not accept the recommendation of the audit committee. So those also have to be now replied to in the board report. So these two changes are proposed in the board report now. Next, moving towards the CSR aspects, CSR as well. So one of the applicabilities for the CSR aspect is that the net profit for the average net profit for last 3 years to be above 5 crore. So that is now proposed to be enhanced to rupees 10 crore. So this, so 10 crore is there. So this also is a relaxation in a way that now lesser companies are likely to fall in the ambit with the enhancing of the net profit criteria. The timeline becomes 90 days, which is the ongoing project. So existing the existing act, the existing provision states that for ongoing projects, the amount is to be mandatorily transferred to the unspent CSR account within 30 days from the closure of the relevant financial year. So 30th April is the due date, which is proposed to be enhanced to 90 days now. So 29th June or 30th June becomes a due date, which is also a kind of a relaxation. And penalty threshold rises to 1 crore or such higher amount which may be prescribed. So that is there. Next is about the auditors aspect. One of the proposal which is also very critical is that it is providing, the bill is providing for prescribed classes of companies fulfilling prescribed conditions to be exempt from appointing auditors under this chapter. So this is one of the critical aspect. Once introduced, we may have more clarity on this, but certain classes of companies are proposed to be exempted from mandatorily the statutory auditor. Mainly, as per the notes, it is for small companies, and also for small companies, the criteria is proposed to be enhanced. So accordingly, will have to be seen. Section 141, again, though every partner of the audit firm must be registered with statutory body established under Indian law having powers. So this is basically to provide for multidisciplinary firms. So auditors, where statutory auditor, cost auditor, as well as secretarial auditor, all three have a similar type of amendment, which actually provides for a multidisciplinary professional firms. So this is that in 141. For 144, the prescribed classes, the restriction extends. So basically, non-audit service restriction. The auditors who cannot provide certain type of activities. So during, of course, the tenure, but now the restriction extends to the company, holding company and subsidiary, and continues for 3 years after completion of the term. So this is one of the proposed important amendments, that non-audit service cannot be provided for now 3 years after conclusion of the term. So this is another, and also there are certain penalties which are proposed. Next is again cost accounting. So cost accounting standards, the government may prescribe certain cost accounting standards, and also the firm eligibility with majority partners practicing in India who are qualified and may be appointed by the firm name. Every partner must be registered with a statutory institute or body, again providing for multidisciplinary firms for cost auditors as well. And there are certain penalties which are prescribed. Directors, so there are, again, as far as governance aspect goes, so we have discussed for auditors, for disclosures, we have discussed for share capital. Now comes the board and directors aspect. Again, very critical changes which are proposed as far as the dean aspects go. So independent director, there is now also look back period. So there is the disqualifying relationships for like disqualification as independent director is also in to be captured real time, because now also current financial year is included. Next is professional association. So in this case, the practicing company secretary word was there in the section, which is not eligible. So practicing company secretary associated with the company is not eligible as an independent director. So that is now proposed to be changed as secretarial auditors, which of the company. So that is one this change which is there. Threshold for materiality benchmark and for independent directors is proposed to be lower than 10%. It is existing, it is 10%, but now also lower percentage may be prescribed. As per the committee recommendation, 5% is the materiality threshold which is proposed. We will have to wait and see in what way it becomes effective. There is also this continuing fulfillment of 149.6 which is there. So basically it is a continuity. It continues with the this aspect that it is to be captured in real time. The qualification of independent director has to be captured in real time. And also this so moving further with it, DIN, very critical and very important amendments which are proposed for DIN number. It proposes for deactivation and cancellation of DIN, which is not there as on the date in the Companies Act, but now it proposed for cancellation as well. So 154 says that deactivated DIN director cannot function. There is also a providing for cancelled DIN, and if there is a deactivation, disqualification, or cancellation, the office of the director automatically becomes vacant. We discussed in the first session that the disqualification, due to disqualification, the office of director, as on the date, it is that office of director becomes vacant in other companies, but in the company in which it is disqualified, the director can continue in that company. But now the proposed amendment is that from all offices of director, that person would the office would be of director would be vacated. Penalty also, it becomes fixed instead of a discretionary. It is up to a maximum of 5 lakh is there. Additional director, again a critical amendment that as on the date, the provision is that additional director can hold office up to the date of AGM or on the AGM in which it should have been held, whichever is earlier. So that tenure is as on the date, but now it is proposed that annual general meeting, the additional director holds office up to the date of next general meeting or 3 months from the date of appointment. So now it is mandatory that in case any additional director is appointed, the company will need to convene a general meeting, whether EGM, whether AGM, and regularize or appoint the person as a director, basically. So casual vacancy, board appointed director also now holds office up to the next general meeting or 3 months from the date of appointment, whichever is earlier. This is very critical as far as a person whose appointment could not be considered or approved in general meeting cannot be reintroduced by the board as additional, alternate, or casual vacancy director without prior member approval. This prevents backdoor entry. So this is these are very critical as far as board of directors are concerned. Next is there is a drafting this which is for penalties. There is a new clause here that for 3 preceding year, as far as 164 section goes, which is on disqualification of director, there is a new clause which is proposed to be introduced, is that an auditor, secretarial auditor, cost auditor, registered valuer, or insolvency professional of the company, its holding company, subsidiary, associate company in the immediately preceding 3 financial year or current year becomes ineligible. This is as far as disqualification, very critical. We have more instances where probably a registered valuer is can be appointed as a director. As on date, it was allowed, but then it is now proposed that any such aspect, auditor, secretarial auditor, cost auditor, valuer, IB professional, all these would in the immediate three preceding financial year would be not be eligible. A person not assessed by board to be fit and proper under prescribed criteria becomes ineligible. Again, fit and proper criteria which was not earlier in place, it is now proposed. Again, critical 164 2A amendment, which we also discussed in first session, for non-filing of financial statements for a consecutive, as on date, it is 3 consecutive financial year. The director attracts disqualification. It is proposed to be now as 2 financial year. So any director, so any company which has not filed for 2 consecutive financial year, director would automatically attract disqualification. The dean would be cancelled, and the director will also vacate office from the company in which it is currently associated. Next is section 165 amendment, which is government may notify a lower class for companies. Yeah, so that power is there with the government. There is 167. The office vacates after 6 months from disqualification or tenure expiry, whichever is earlier. Functioning despite deactivation or cancellation attracts penalty. So exit is clearly provided in section 167, which is to be noted clearly. For this one, this are the calendar year. So basically, this one meeting in each half, it is a calendar year. Now it is that is a drafting this. Section 184, which provides for interest, director's interest, basically MVP 1 form, which is as on date, it is to be noted at first board meeting in every financial year for the companies. It is now proposed to be done away with, and in case of any change, then only if there is any change, then MVP 1 is to be done 1 month after such change. The annual requirement of this directors, this interest in other companies is now not required. Section 185, loan to director, it is all limited liability partnership are added. So in a way, it is now made applicable to LLPs as well. Very important to know, loan to directors, which was there in 185 of Companies Act. By this mere addition of all limited liability partnership, it is now made applicable, proposed to be made applicable to limited liability partnerships as well. Next is about the investments, related party transactions, and those aspects. So 186, again, there is this penalty provisions which are there. Earlier, there was no separate penalty, but now these penalties are now proposed, which is a part of decriminalizing. Section 203A, which is again an important provision, that a key managerial personnel, so there was no such provision as on date, there is no such provision, but it is proposed that a KMP may resign by notice and board must take note and intimate to the registrar. If company fails to do so, KMP, the key manager person, can file copy with detailed reason, and the liability for default during the tenure would survive the resignation. So here that flexibility is also now given. It mirrors the director's resignation, also has similar provision. Now KMP also is would be eligible now to with such a provision. In 204, again, practicing company secretary, the word is changed to secretarial auditor, which is in line with other amendments as well. Next is certain aspects about the merger provisions. In this also, there are certain this drafting, this clarification which are there. The critical is for fast track merger. Existing provision is for fast track merger is up to 90% of the value of shares held by such members. So the fast track merger has to be has to be confirmed by 90%, up to 90% of the this shareholders. It is proposed to be reduced to 75% in value held by such members present and voting. Creditor threshold becomes at least 3/4. So those provisions are proposed to be aligned now. And there is a new section, this such shares must be dealt with or disposed within 3 years. Failing that, they are to be cancelled, extinguished, and deemed to be capital reduction, and continuing default at tax penalty. So there is a treasury share structures from the arrangement. So it is dealing with such structures. Valuation, there is a new also framework proposed for valuation as well. IBBI, the Insolvency Bankruptcy Board of India, becomes the statutory this valuation authority for 247 purposes. We already discussed about LLPs, so 247 being made effective to applicable to LLPs as well. So here also the statutory body IBBI is proposed. Valuation authority may recognize valuers, organizers, register valuers. So all the aspects are now, the power is given to IBBI. Fraudulent contraventions by valuer or valuers can attract imprisonment or higher fines. Government may prescribe valuation standards as well. So that is proposed. And for strike off now, it is ground is expanded to include inactivity in the current year, absence of significant accounting transaction in the preceding 2 financial year and current year, and non-filing of financial year for 2 consecutive financial year. So that is also the cleanup drive which is there. We have discussed in detail about the strike-off provisions in the first session, and this is also now including current year as well. There is a prescribed manner is inserted for extinguishing a liabilities. The person other than the company may show cause. Terminology is aligned for striking of the name. So this is critical. There is also this penalty which is prescribed in this. Moving forward, the regional directors, the fine-based punishment is replaced with company or penalty structure is there, which is more towards the this decriminalizing of offenses. There are also the additional fees, again critical, for section 403 for annual filing in certain cases where 100 rupees per day is prescribed, basically for annual filing without any upper limit. It is now prescribed that the additional fees may be capped at 2 lakh rupees for prescribed class of companies, which may also come as a bit of a relaxation. Again, critical section 441 amendment. Threshold for regional directors, the matters which are dealt with by regional directors, the penalty threshold early, which is as on date 25 lakh, is proposed to be enhanced to 1 crore. So that is again, more matters can stay at the RD, and there is also a reduced penalty level. The penalties become 1/2 for such lower percentage, not exceeding 1/2. So that is in a way lower penalties, as well as RDs would have more this authority, and NCLTs, the tribunals will be relaxed. There are monetary thresholds which are for, again, the decriminalizing policy is continuing, and basically these are the broadly thing. So if I may summarize the discussion in this part of the session, there are, so for on one hand, there is a modernization of instruments which are proposed, whether it is securities, so various value link compensation, the restricted stock units, SARs are recognized. Digital governance is normalized. The AGM, EGM can be held in hybrid also, which is there. There are procedures prescribed as well. IFSC entities give now are LPs or Companies Act, including this permitted foreign currency and those aspects. So these are also recognized. Audit and valuation ecosystem is strengthened. There are separate these governing bodies. The NFRA is now becomes the regulator. And also the valuation aspect is IBBI. The offense is again the push towards decriminalizing is continuing in over here as well. The regional directors get the authorizing officers get more of a operational role, and also the tribunal process is reduced. What areas of this impact are there as a practicing professional? So private placement documentation, compensation structures are recognized, so that can be an area. IFSC very critical for us as ancillary services being recognized. IFSC accounting, capital maintenance, the filing, all those things in permitted foreign currency becomes the operating base. Board report also, the changes are to be noted, whether they are audit observations, audit committee recommendations, all those things. NFRA registrations, non-audit service restriction is something to be taken care of. And as far as governance goes, the independent directors have a continued eligibility as on the date as well. There is a fit and proper criteria for the board as well. The DIN cancellation, the verification deactivation risk, and within 6 months those cancelled DINs have to be restored as well. All those things are there. The fast track merger approvals, there is a lower threshold of the shareholders approval. Instead of 90%, now 75% in value. There is also legacy shareholding cleanup, strike off and restoration. The wider strike off triggers partial move towards RD jurisdiction. There is also adjudication and recovery strategies. So these are the broad areas, and with this I conclude my presentation, and over to you, sir. And we are open for any questions as well.
Yes, sir. Thank you, Raj sir, for a very wonderful and comprehensive presentation, as well as the deliberations and information on the proposed company's bill. I think the way you have presented it, making it simpler for everyone. The presentation itself, like the existing provisions, the new amendments. So I think there are a lot of takeaways and the opportunities, as you said, that what are the upcoming opportunities for the professionals. I think all in all, a wonderful 1 hour of listening to you. I think there is a question in the chat box that when is this bill likely to receive the president's assent?
It
So
is
if you have any info about it.
currently like it will be in probably the monsoon session of parliament. It is with the JPC. It is open for consultations as well for professionals. So we may have it in the upcoming session as well. It is already introduced in Lok Sabha. So very soon we may or may not, we may have some changes as well. But broadly, we got to know the idea behind overall thinking of the MCA and what are the provisions are this.
There is one more question. Like, can you please explain the I think 1 second. There was a question that provisions of loan to the partners in the LLP.
There are
So
section 185 of the Companies Act is proposed to be made applicable. As on date, it is not. So you can continue, but it is proposed. So for companies also fulfilling certain criteria, only then the loan to the director is allowed. Similarly, the loan to partners is proposed. So section 185, as on date, it is not, but we may or may not have. That is the thing. But it is what the idea is currently.
Does that mean that the LLP will not be able to give the partners the amount which has been brought in more than the capital they can transfer to the partners? Does that mean
There may have be certain restrictions which may be brought in, just like for private companies there are some relaxations as well by way of some resolutions which can be done. So similarly, we may have the framework for the LLPs as well. As on date, there is nothing. So I also suggest that not to take immediate action, but just keep in background that yes, this is what the idea is overall.
Because sir,
That's what.
generally right now what happens is the tax rate for LLP is higher than the company. But one reason why people prefer LLP rather than companies because of its compliance and specifically for this
Correct.
loan section.
Correct.
Because there is easy mobility of funds in LLP.
Yeah.
And if this comes in, then there will be, change in the market.
Correct. Yes. So that probably is that they may tighten and they may also give some relaxation as well. So we have to wait for the regulations as well, that what exactly is proposed and which LLPs. For LLPs also we have the concept of small LLPs and startup LLPs. We may have a situation when if that criteria is there, then there are certain relaxations like we have for companies and small companies. So that also is possible. We'll have to wait for that. So
then, sir, as we our community has certain representations on some tax amendments that may that are produced. So is there any representation expected from the CS community against such provisions of LLP, at least for that matter?
yeah, we so there are so we the institute also has sought comments from the professionals and the representation for sure. There are also multiple sessions which have been held with the ministry officials as well. So the ministry officials also are welcoming suggestions. So we may of course have a like complete picture. So that is of course in process currently.
Because as Khushbu mentioned, the currently the cushion for an LLP is only the probably the loan transactions. That is a cushion for an LLP and a differentiator between an LLP and a private limited. So if even that is being taken off, then maybe LLP may not have such an importance even after having a higher tax rate. So, but yes, all in all, a very wonderful session, sir. Rima, Khushbu ma'am, you can take over, please.
So thank you, sir. So as we come to closer to today's session, I would like to thank our speaker, CS Raj Kapadia, for sharing his valuable insights on company's amendment bill 2026 draft. Your session, sir, has helped us understand not just the proposed amendments, but also the thought process and direction in which corporate laws are evolving. The practical perspective shared by you today will certainly assist all of us in aligning our advisory and compliance approach going forward. Your detailed analysis and practical perspective on the proposed amendments have given all of us a clear understanding of the evolving regulatory framework and its implication for our professional practice. I hope all participants found today's session insightful and enriching. I would now like to invite Sri Nidhi Kakkar to kindly deliver the vote of thanks.
Hello. Thank you, Khushbu. On behalf of everyone, I present a formal vote of thanks to Raj sir, the distinguished company secretary, for the insightful session on the company's amendment bill, which is still a draft. But many of the eye-opening provisions which we are waiting, that once it receives the assent, we are supposed to get in touch with those amendments. We truly appreciate you for accepting our invitation and sharing your valuable expertise with us. The session was presented in a very simplified and structured manner, making the subject easy to understand. Particularly noteworthy was how the amendments were explained along with the existing provisions, highlighting not only why the amendments matter, but also the immediate impact which it would have. The presentation reminded me of the approach seen in the new Income Tax Act in a tabular format, giving the better clarity to the provisions and your ability to simplify the concepts and provide the practical insights. And thank you, sir, for your time and making the session so meaningful. Once again, special thanks to Kaushik, sir, who brought along his team whose collective inputs and perspective enriched the session further and gave us an well all-rounded understanding of the subject. Thank you so much.
Thank you very much. Thank you very much for the opportunity.
Thanks to all the participants as well to join in large number. And thanks to Kaushik sir again. Yes. So I think we can formally conclude the meeting here.